Data has remained relatively uninspiring this week. We've had soft housing data from the US and also quite a weak result for Chinese trade. It's fair to say that the outcomes we have seen this month are more about month-to-month volatility than they are an outright deterioration relative to a few months ago. That's particularly the case with China, where we saw an above expectations result for December, now followed by a weaker than expected result for January. It's fair to say that volatility is likely to continue for the next month or so. Obviously, we have the Chinese Lunar New Year holidays, which also always impact the trade data and sort of the general data flow that comes out in China and from the rest of the Asian region at this time. So that's likely to be with us for some time yet. Against these results, however, we have seen, I guess, a much more optimistic and positive market trend, with a rally in risk assets taking on quite a significant scale this week. And that's been partly due, obviously, to short covering after the significant declines we saw in the last week or so, and also being sort of, I guess, fair to say that because the market sort of got ahead of itself relative to what the real economy was actually telling us on a global basis. The other point to note really is that we have seen, I guess, a more cautious and a more willing approach from policymakers around the world. It's particularly the case in Europe, where we saw Draghi not only before the European Parliament but also in the minutes that came from their last Governing Council meeting, really again emphasised the weakness we have seen in inflation, the potential risk we're seeing from emerging markets, and also from sort of the, I guess, the ructions we've seen in markets around European banks as well. On top of all that, he again emphasised that sort of the ECB's willingness to act, and also called again on fiscal authorities in the region to provide further stimulus as well, which is again really one of the sort of key parts that's been lacking over the last few years, and something we really need to see come through to provide greater support to the economy there. Across in the US, we again saw, I guess, a more cautious tone from the Fed in their minutes. They do remain quite positive in terms of the labour market, and they're optimistic again on the consumer, which is really what's been driving US growth. That being said, they are, I guess, very cautious as to what the potential implications of the higher US dollar and also sort of the volatility we're seeing around the world could mean for the US economy. For us, that means they're likely to remain unchanged in March and basically wait it out until sort of June into Q3 before they start to continue the normalisation process. And we continue to believe they're likely that they will likely hike rates in June, September and December. So it's continuing to, I guess, maintain our above consensus call and also just really emphasising the importance of the labour market and the underlying domestic demand to that Fed view. If we come back to Australia, what we're seeing this week is, again, an RBA which remains quite positive about the outlook, despite sort of what's been going on globally. Again, that's really been predicated on what's been happening in the labour market and an expectation that would flow through into greater consumption and then non-mining investment later on. The one sort of figure to note this week that has, I guess, put a little bit of, or cast some doubt over that, is what we saw with the labour market report. We did see the unemployment rate rise to 6% there, which is a bit of a surprise. We had been expecting, I guess, about a 5.9% outcome, which still would have been an increase from the previous month, but only one that's really consistent with month-to-month volatility. The 6% obviously could still be month-to-month volatility. Obviously, we had very strong outcomes last year. We've had 2 weak employment outcomes now, which has led to this result for the unemployment rate. But it also, I guess, puts into question the RBA's view on unemployment and the employment growth overall. In the statement and in their minutes, they had noted that they expected that the unemployment rate would continue to decline from its 5.8% and therefore remain below 6%. And that was kind of their core view. So this does kind of raise questions as to whether that's accurate, and we'll have to wait and see in coming months as to how the data settles down and whether we do see sort of 6% remain, the unemployment rate remain around 6% or trend higher still. That's obviously going to be really quite key for the RBA outlook as we move over the next sort of 6 to 12 months. It is fair to say it's likely that they'll need to see a more significant deterioration from where we are now if they are to think that it's appropriate to actually cut rates again. And we do remain of the view that they won't do that. Looking forward next week, the focus is really going to start to be on the GDP partials. We have CapEx and construction work done, and also the wages outcome as well. So CapEx expectations will be really quite key to get an update on where businesses are at and what they're expecting to spend over the current sort of financial year. And that's really a key sort of focus for the RBA in trying to hope to see non-money investment come through. Construction work done provides us an understanding of what's been happening with construction work in the sector across the residential and non-residential space, but only for the current quarter. So we'll come back and wrap all that up for you next week.